They were once household names, packed dining rooms, loyal customers, locations in every city. But now, these big-name restaurant chains are quietly collapsing. Rising costs, shrinking menus, store closures, and bankruptcy rumors are painting a grim picture for 2025. Some are downsizing, others are disappearing. And if you've been wondering why your local spot suddenly closed, it's not just bad luck. In this video, we're diving into 10 restaurant chains that are falling apart right now and what's really driving their decline. If one of your favorites is on this list, it might be time to say goodbye. Before we get into it, drop your city in the comments. Let's find out which of these chains are disappearing fastest and where. And hit that like button if you've seen any of these places shut down near you. It helps get this warning in front of more viewers. The restaurant world in 2025 isn't what it used to be. Between inflation, supply chain headaches, rising wages, and shifting customer habits, some of America's biggest chains are struggling just to stay open. Dining rooms are empty, staff is short, and locations are closing quietly across the country. These aren't small local diners, these are national names. And in this video, we're breaking down 10 major restaurant chains that are either shrinking fast or standing on the edge. If you eat out regularly, this list might change where you go next, or warn you before your favorite spot disappears. Before we get into it, drop your city in the comments. Let's find out which of these chains are disappearing fastest and where. And hit that like button if you've seen any of these places shut down near you. It helps get this warning in front of more viewers. Number 1, Red Lobster. Once the go-to destination for affordable seafood and those iconic Cheddar Bay biscuits, Red Lobster is now navigating turbulent waters. In May 2024, the chain filed for Chapter 11 bankruptcy, burdened by over $1 billion in debt. This move led to the closure of more than 100 locations across the US and Canada, with additional closures following in August. A significant factor in Red Lobster's downfall was its Ultimate Endless Shrimp promotion. Introduced as a permanent $20 menu item in 2023, the deal backfired spectacularly. Customers flocked to take advantage, but the promotion led to an $11 million loss in a single quarter, overwhelming supply chains and stressing staff. Ownership changes further complicated matters. Thai Union, a major seafood supplier, had acquired full ownership in 2020. Their influence over procurement, especially regarding shrimp, raised concerns about conflicts of interest and contributed to operational inefficiencies. In a bid to steer the ship back on course, Red Lobster appointed Damola Adamoleken, former CEO of P.F. Chang's, as its new leader in August 2024. Under his guidance, the company secured a $60 million investment from RL Investor Holdings and began implementing strategies to revitalize the brand. These included menu overhauls, enhanced customer service initiatives, and ambiance improvements. Despite these efforts, challenges persist. The chain's footprint has been reduced to approximately 545 locations, down from 649 at the end of 2023. The casual dining sector faces stiff competition from fast casual eateries and changing consumer preferences, making recovery an uphill battle. Red Lobster's journey serves as a cautionary tale. Aggressive promotions without sustainable planning, coupled with ownership complexities, can sink even the most established brands. As the restaurant industry evolves, only time will tell if Red Lobster can reclaim its former glory or become a relic of the dining past. Number 2, Applebees. Once a staple of American casual dining, Applebees is now navigating turbulent waters in 2025. The chain has been grappling with declining sales, shifting consumer preferences, and increased competition, leading to a series of store closures and strategic overhauls. In the first quarter of 2025, Applebees reported a 2.2% decline in same-store sales, reflecting the broader challenges facing the casual dining sector. This downturn is attributed to consumers tightening their budgets and opting for more affordable dining options or cooking at home. To counteract these trends, Applebee's introduced a $9.99 really big meal deal, aiming to attract cost-conscious diners. However, the promotion has yielded underwhelming results, with analysts expressing skepticism about its effectiveness in reversing the brand's fortunes. Compounding these issues, Applebee's has faced operational challenges with its franchisees. Notably, 8 locations in the Kansas City area were abruptly closed after the franchisee filed for bankruptcy, highlighting the financial strain within the franchise network. In response to these challenges, Applebee's parent company, Dine Brands, has initiated the Looking Good program, aiming to revitalize the brand through restaurant remodels and dual branding. Initiatives with IHOP, The strategy includes converting select locations into combined Applebee's IHOP establishments, a move that has shown promise in boosting sales. Despite these efforts, the outlook remains cautious. Dine Brands projects a net decrease of 20 to 35 Applebee's locations in 2025, signaling ongoing consolidation and strategic repositioning. Applebee's current struggles underscore the broader challenges facing traditional casual dining chains in adapting to evolving consumer behaviors and market dynamics. The brand's ability to innovate and reconnect with its customer base will be critical in determining its future trajectory. Number 3, Chili's Grill and Bar, a staple in the American casual dining scene, is confronting significant hurdles in 2025. Despite a history of resilience, the chain is grappling with shifting consumer preferences, intensified competition, and operational challenges. Recent reports have highlighted a decline in foot traffic across various Chili's locations, attributed to the growing popularity of fast casual dining options and food delivery services. This shift has compelled the brand to reevaluate its traditional dine-in model, which has been a cornerstone of its identity. In response to these challenges, Chili's has initiated several strategic measures. The company has streamlined its menu to focus on core offerings, aiming to improve kitchen efficiency and reduce operational costs. Additionally, investments have been made in digital ordering platforms and curbside pickup services to cater to evolving customer behaviors. Financially, the parent company, Brinker International, has reported mixed results. While certain quarters have shown promising sales figures, the overall performance indicates a need for sustained innovation and adaptability to maintain market relevance. Despite these efforts, the road ahead remains uncertain. The casual dining sector is undergoing a transformation, and Chili's must navigate these changes to avoid further decline. The brand's ability to adapt to the digital age, revamp its customer experience, and offer value-driven options will be critical in determining its future trajectory. For loyal patrons, the hope is that Chili's can reinvent itself while preserving the elements that made it a beloved dining destination. Only time will tell if these initiatives will steer the chain back to stability or if it will continue to struggle amidst a rapidly evolving restaurant landscape. Number 4, Ruby Tuesday. Fading from the American dining scene. Once a staple in the American casual dining landscape, Ruby Tuesday is now confronting a series of challenges that threaten its survival in 2025. Known for its garden bar and family-friendly atmosphere, the chain has seen a steady decline over the past decade, culminating in a significant reduction of its footprint across the United States. The onset of the COVID-19 pandemic in 2020 dealt a severe blow to Ruby Tuesday, leading the company to file for Chapter 11 bankruptcy protection. This move resulted in the closure of hundreds of locations, leaving the chain with a fraction of its former presence. As of early 2025, Ruby Tuesday operates fewer than 200 restaurants nationwide, a stark contrast to its peak of over 800 locations. Several factors have contributed to the chain's decline. Changing consumer preferences have shifted towards fast casual dining and delivery options, areas where Ruby Tuesday has struggled to compete. Additionally, the chain's efforts to revamp its menu and modernize its brand have failed to resonate with a younger demographic, leading to a loss of relevance in a competitive market. Financial struggles have further hampered Ruby Tuesday's ability to invest in necessary upgrades and marketing initiatives. The company's limited capital has made it challenging to refurbish aging locations or implement technology-driven solutions that are now standard in the industry, such as mobile ordering and loyalty programs. In an attempt to stabilize its operations, Ruby Tuesday has explored various strategies, including franchising opportunities and partnerships with third-party delivery services. However, these efforts have yielded limited success, and the chain continues to face declining sales and customer traffic. The future of Ruby Tuesday remains uncertain. While the brand still holds nostalgic value for some patrons, it must undergo significant transformation to regain its footing in the evolving dining landscape. Without substantial investment and a clear strategic vision, Ruby Tuesday risks fading entirely from the American dining scene. Number 5. TGI Fridays. From iconic to insolvent. Once a trailblazer in the casual dining scene, TGI Fridays is now grappling with significant challenges in 2025. The chain, renowned for its vibrant atmosphere and signature dishes, has seen a dramatic decline in its U.S. presence. In November 2024, TGI Fridays filed for Chapter 11 bankruptcy, citing financial strains exacerbated by the pandemic and changing consumer behaviors. At the time of filing, the chain operated approximately 160 U.S. locations. However, by April 2025, this number had dwindled to just 85, marking a substantial contraction from the 270 locations at the beginning of 2024. The bankruptcy proceedings led to the closure of numerous underperforming restaurants, including 30 in a single month. The company attributed these closures to the need for strategic realignment and cost optimization. Despite these efforts, the brand continues to face stiff competition from fast casual eateries and a shift in consumer preferences towards delivery and takeout options. In an attempt to revitalize the brand, TGI Fridays announced a comprehensive menu overhaul in May 2025, revamping approximately 85% of its offerings. The changes aim to streamline operations and cater to evolving customer tastes. However, industry analysts remain skeptical about the effectiveness of these measures in reversing the brand's fortunes. TGI Fridays maintains a stronger presence, with over 600 locations worldwide. The company is focusing on leveraging its global footprint to stabilize operations and explore growth opportunities in markets less saturated with casual dining options. The future of TGI Fridays hinges on its ability to adapt to the rapidly changing dining landscape. While its legacy endures, the brand must innovate and resonate with a new generation of diners to avoid fading into obscurity. Number 6. Olive Garden. A beloved brand facing new pressures. Olive Garden, long celebrated for its Italian-American cuisine and signature unlimited breadsticks, is navigating a complex landscape in 2025. While the chain remains a significant player in the casual dining sector, recent developments indicate shifting dynamics that could impact its future trajectory. In early 2025, Olive Garden experienced a 2.9% decline in same-store guest traffic attributed to inflationary pressures, affecting consumer spending habits. Despite this, the brand reported a 0.6% increase in same-store sales, largely driven by menu price adjustments. To counteract declining foot traffic, Olive Garden has implemented several strategic initiatives. Notably, the chain partnered with Uber to launch a white-label delivery service, allowing customers to order directly through Olive Garden's platforms, with deliveries fulfilled by Uber's network. This move aims to enhance convenience and capture a broader customer base. Additionally, Olive Garden has reintroduced popular menu items, such as the never-ending pasta bowl, to entice diners and boost in-restaurant experiences. These efforts are part of a broader strategy to rejuvenate the brand's appeal amid evolving consumer preferences. Despite these proactive measures, Olive Garden has faced increased competition. In 2025, Texas Roadhouse surpassed Olive Garden as America's top casual dining chain, signaling a shift in consumer tastes towards alternative dining experiences. Financially, Olive Garden continues to contribute significantly to its parent company, Darden Restaurants. In the third quarter of fiscal 2025, Olive Garden generated $1.33 billion in sales, reflecting a modest growth from the previous year. As Olive Garden adapts to these challenges, its focus remains on enhancing customer engagement through menu innovation, strategic partnerships, and leveraging technology to meet modern dining expectations. The brand's ability to evolve while maintaining its core identity will be crucial in sustaining its position in the competitive casual dining landscape. Number 7. Dennys, the 24/7 diner. Feeling the heat, once synonymous with late-night comfort food and round-the-clock service, Dennys is now grappling with significant challenges in 2025. The iconic diner chain is undergoing a substantial transformation, marked by widespread closures and strategic shifts aimed at revitalizing its brand. In its first quarter earnings report for 2025, Dennys announced plans to close between 70 and 90 restaurants this year, adding to the 88 closures in 2024. This brings the total to approximately 180 closures over 2 years, exceeding initial projections. The closures primarily target underperforming locations with expiring leases or outdated facilities, as the company seeks to streamline operations and focus on more profitable units. Financial performance has also been a concern. In the first quarter of 2025, Dennys reported a 3.0% decline in same-restaurant sales, reflecting broader challenges in the casual dining sector. Net income dropped to $0.3 million or $0.01 per diluted share, a significant decrease from the previous year. The company attributes these declines to inflationary pressures, changing consumer behaviors, and increased competition from fast casual and delivery-focused establishments. In response, Dennys is implementing several strategic initiatives. The company plans to open 25 to 40 new restaurants in 2025, including both Dennys and its sister brand, Keki's Breakfast Cafe. Additionally, Dennys is investing in remodeling existing locations to enhance the dining experience and appeal to a younger demographic. Digital ordering platforms and delivery partnerships are also being expanded to meet evolving customer preferences. Despite these efforts, the road to recovery remains challenging. The brand's traditional 24/7 service model is under scrutiny, with some franchisees reducing operating hours due to labor shortages and decreased overnight demand. Menu simplification efforts aim to improve efficiency, but risk alienating longtime patrons accustomed to a broader selection. Dennys' situation underscores the broader struggles of legacy casual dining chains in adapting to a rapidly changing food service landscape. While the company is taking proactive steps to reinvent itself, success will depend on its ability to balance innovation with the nostalgic elements that once made it a beloved fixture in American dining. These restaurants weren't just businesses, they were part of the American dining experience for decades. But now, rising costs, changing habits, and industry shakeups are forcing even the biggest names to shrink, rebrand, or disappear entirely. Some may bounce back. Others may never recover. Now we want to hear from you. Which of these chains have you eaten at recently? Which one do you miss or want to visit before it's too late? Drop your answers in the comments. We're tracking where these closures are, hitting hardest, and your story could help map the real picture. If you've seen one of these restaurants close in your area, share your city, and let us know if there's a chain you think should have made this list. Smash that like button if this list gave you a surprise, and subscribe for more eye-opening updates on food, retail, and survival news before the rest of the internet catches up. This isn't just fast food, it's a fast-changing world. Stay informed, stay ready, and stay ahead.